So friends, so in the previous lecture we have completed Gordon's model for dividend theory. Okay, now we are going to learn about another model which is known as the bird in hand theory, which is a revised form of the Gordon's model. Okay, it's a very small theory, and there is a one formula which is almost similar to the Gordon's formula which we learned in the previous lecture. Okay, now what does this theory stipulates? Okay, bird in hand theory. Bird in hand theory. So you might have heard about an old saying which says that a bird in hand is much better than or much preferable than two birds in the bush. Okay, so if you have something in your hand, that should be given more value than something more which is not in your hand but elsewhere. Okay, so this is a very old saying, and the same principle is being applied in the case of stock valuation or dividend theories. Okay, so when you talk about a particular stock, okay, the stock is capable of giving two types of returns. One is dividend and the other one is capital appreciation. Capital appreciation. Now when you look at these two returns, that is dividend and capital appreciation, which is more certain? Out of these two, the dividend is more certain, because dividend is something which you get today or now. Okay, whereas capital appreciation is something which you can encash in future. So as per this revised Gordon's model, the Gordon specifies that we should give more prominence or importance to the current dividend than the future capital appreciation or capital gain. Though there are no differences in the tax rates or in the returns on both dividend and capital appreciation later, okay, due to this bird in hand theory, the model says that the investors will give more weightage to the dividend. So that is why there is a preference for dividend paying stocks on as compared to the other capital appreciation stocks. Now very particular example from international context is Coca-Cola. Coca-Cola is a company which pays regular quarterly dividends for the last so many years, and it follows the bird in hand theory. Only if you pay regular dividends to the investors, they will be interested in your stock. Similarly, from the Indian context, you have companies like ITC, you have Infosys, Reliance, all these major players, they tend to give dividend returns to the investors, which is almost certain, and of course there will be a capital appreciation parameter. Okay, so that is this model, dividend, the bird in hand theory or Gordon's revised model. Okay, now you have to see what is the formula that is given in this particular model. Okay, as per this model, the market price per share, market price per share, that is P0, is a function of three parameters. One is D0, D0 is the present dividend, plus 1 plus G, that is the future dividend, divided by KE minus G. Okay, so D0 into 1 plus G, that is nothing but D1. D0 into 1 plus G is the D1. Okay, divided by KE minus C. See, this is also a formula which we have learned in our chapter 2 and we have used in multiple chapters. So it is not a new formula for you, and this formula is given by the Gordon. Okay, so we know what is P0, we know what is D0. D0 is the current year dividend or present dividend. Okay, and G is the growth rate. Then KE is cost of equity, cost of equity or expected return, expected return. Okay, now when you see this formula, what does this formula perceive or states? This formula says that when the rate of return R is greater than KE. Okay, when R is greater than KE, the cost of equity, the price per share increases, when the dividend payout or dividend ratio decreases, when dividend ratio decreases. What is this principle? See, when dividend ratio decreases, what happens? Okay, your retained earnings increases. When your retained earnings increases and R is greater than KE, you are able to reinvest that retained earnings at a higher rate than your cost of equity. So naturally, it will increase the value of the share. This is a principle which we have employed in previous models also. It's a concept. On the other hand, if R is less than KE, what will happen to the price per share? Price per share increases when what? Dividend ratio decreases. Okay, so if R is greater than KE, the company should always try to reduce the dividend payout ratio. Whereas if R is greater than, so if R is less than KE, it has to increase the dividend payout ratio. If R is greater than KE, it has to reduce the dividend payout ratio. Okay, so reduce or decrease. Here dividend ratio increases, I think. Just opposite. Okay, fine. So that's all with this model. Now I am not going to do problems on this model because we have already done on this. Now we are moving to the next topic, which is known as dividend discount model. Dividend discount model or DDM. Okay, what is this dividend discount model? As per this dividend discount model, the intrinsic value of a share, is nothing but it is equal to sum of present value of future cash flows. And the future cash flows means there are two types of cash flow from a dividend or from a stock. One is the dividends and the other one is capital receipts on sale. Okay, so this is equal to sum of PV of dividends or future dividends in future plus what? Present value of stock sale price. Okay, whatever be the stock sale price at the end of the period, that also have to be discounted and its present value have to be taken. So you have to discount all your future dividends, and with that you have to add the present value of your future stock sale price. Okay, so this is how you find out the intrinsic value. Now when it comes to the this model, there are a couple of problems, okay, depending upon the growth rate in the dividend. Okay, now when you talk about the dividend discount model, the increase in or the growth in dividend can have three situations. One is no growth. That means no growth in dividends, which means every year it will be the same dividend which is being paid. Now second one is constant growth. That means every year there is a constant growth in dividend, let's say 5% or 10% like that. Constant growth in dividend. And the third one is variable growth. Variable growth means you can't have a pattern for growth. Few years it will be increasing and after that, it will be increasing at a limit and after that at a different limit, like that it goes. Okay, so let's do some problems. So the first one is the valuation when there is zero growth rate. For dividend. See, when there is no growth rate for the dividend, the intrinsic value, IV means intrinsic value, intrinsic value of stock is equal to annual dividend divided by what? Required rate of return. Okay. Okay, and what is annual dividend? Annual dividend is D and the required rate of return is KE. And with respect to annual dividend, there is no increase or decrease. It is zero growth. So it will be constant always. KE we know, which is the cost of equity or required rate of return for the equity. For equity holders. This is the formula. And if you see some questions on this, okay, let's do some problems on this. X Limited is a no growth company, pays a dividend of rupees 5 per share. If the cost of capital is 10%, compute the current market price of the share. So it's a very simple problem. There is nothing complicated. So it's a zero growth company. So MPS or P0 is equal to D divided by KE. And what is D? D is 5. There is no growth. And cost of capital is 10%. So this is equal to rupees 50 per share. So simply take the dividend and capitalize it with the capitalization factor. Okay. Now, next one, constant growth. Constant growth in dividend, which means the dividend increases or grows every year by a specific percentage. If that is the case, intrinsic value or MPS is equal to, we have already learned the formula, D0 into 1 plus G divided by KE minus G. KE minus G. Okay, the same formula which we saw in the case of the birds in hand value or the model. Okay, I don't have to explain this. So this is D0 is the current dividend or present dividend. Then G is nothing but B into R, retention ratio into rate of return, which is the growth rate. And this is constant. Then KE is cost of equity. Okay, now let's do a problem. So XYZ Limited is a company having share capital of rupees 10 lakhs of 10 each. A distributed current dividend of 20% per annum. Annual growth rate in dividend is expected to be 2%. Expected return on its equity is 15%. Calculate the price per share for applying the Gordon's growth model. Okay, so share capital is 10 lakhs of rupees 100 each. So it's question number 10. Okay, So what is the share capital? Share capital is 10 lakhs of rupees 10 each. It distributed current dividend of 20%. So D0, that is current dividend, is 20% of rupees 10, that is rupees 2 per share. Then KE is how much? 15% and G is 2%. Now simply apply this formula. Market price or P0 is equal to D0 into 1 plus G divided by KE minus G, that is equal to 2 into 1 plus 0.02 divided by 0.15 minus 0.02. Okay, so that will give you 2 into 1.02. So 2 into 1.02 will give you 2.04 divided by 0.15 minus 0.02, that is 0.13. So 2.04 divided by 0.13 will give you 15.69. 15.69 per share. Okay, so that is the value per share when there is constant growth rate. Now the third scenario is when there is a variable growth rate. That means the growth rate changes from year to year. Variable growth rate. So when there is growth rate, change in the growth rate, you have to consider it accordingly. Let's say for the initial 3 years it is growing at 10%. Then after, let's say for the next 5 years it is growing at, let's say 5%. And after that it is growing at 2%. So there are different rates given for different periods. Then you will have to find out what is the present value of all those dividends for each of that year, and accordingly you have to determine the intrinsic value. Okay, that's it. There is nothing new, or there is no concept. You have to simply take identify what are the dividends that you are going to get in each of the year, then discount it to the present value, then add the present value. That's it. Let's do a problem here. I'm sorry. Okay, so what does the question says? A firm had paid a dividend of rupees 2 per share last year. The estimated growth rate of dividend from the company is estimated to be 5% per annum. Determine the estimated market price if the estimated growth rate of dividend rises to 8%, falls to 3%. Also find out the present market price of the share given that the required rate of return is 15%. So there are 3 scenarios. One, present growth rate is 5%, then that growth rate rises to 8%, then the growth rate falls to 3%. What is the impact on the market price? That is what we have to compute here. So simply applying the Gordon's model. So present MPS P0 is equal to D0 into 1 plus G divided by K minus G, that is 2 into, okay, present it is 5. So 1 plus 0.05 divided by K is 0.15 minus 0.05. Okay, and if you compute this, 2 into 1.05 is 2.1 divided by 0.15 and that will give you rupees 21 per share. So present value is 21 point per share. Now when G is equal to 8%, so G increases to 8%, what will happen? P0 is equal to D0 into 1 plus G divided by Ke minus C. So D0 is 2 itself, plus 1 plus 0.08 divided by Ke means 0.15 minus 0.08, and that will give you 2 into 1.08 is 2.16. Okay, 0.15 minus 0.08 is 0.07, and that will give you 2.16 divided by 0.07 is 30.86, rupees 30.86 per share. Okay, and the last one, G decreases to 3%. So when G is equal to 3%, again just apply in the formula. P0 is equal to 2 into 1 plus 0.3 divided by 0.15 minus 0.03. So this is 2.06 divided by 0.12. 2.06 divided by 0.12, the value will be rupees 17.16 per share. So that is when G is 3%. Okay, so what is the conclusion? As the growth rate changes, the market price is also expected to vary. So the conclusion will be, as the growth rate in dividends changes, the intrinsic value of the shares is also expected to change. Expected to change. Okay, now that's all about the Gordon's model. Now what are the advantages of this Gordon's model? One of the most important advantages, okay, this considers both the capital appreciation as well as dividend value, because we are considering the future dividends as well as the growth appreciation, and this is very easy to understand also. Okay, so that is the advantage of this model. Now you have another model which is known as traditional models. Traditional models. There are two models under this. One is Graham and Dodd model. Graham and Dodd model, and the last one is Linner's model. L-I-N-T, Linner's model. Okay, Graham and Dodd model and Linner's model. Now let's take Graham and Dodd model. Okay, this is a very simple concept. Now according to this Graham and Dodd model, okay, now when it comes to dividend and capital appreciation or capital gain, this model says that the dividends are given more weightage than capital appreciation. Why is it so? Because dividends are something which is certain. The investors know that they will get it today, whereas capital appreciation is something which they expect in future. So it might come, may not come. So this, since there is a uncertainty with respect to capital appreciation, dividends are given more weightage or capital appreciation is given only less weightage. Okay, so when you do the valuation, the dividends are given more weightage, and if you see the weightage what is given, dividends are given 3x of capital appreciation. Okay, so if capital appreciation is given 1 weightage, dividends will get 3 weightage. Or if dividends is getting 1 weightage, capital appreciation will get only 1/3 of weightage. Okay, so that is this principle. And according to this formula, the market price P is equal to D plus, D means dividend. Dividend is simply added. So usually what we do, the return will be D plus E. Am I right? D stands for dividend and E stands for earnings. Okay, D plus E minus D. Okay, but here what we do, D plus E, we are taking not E minus D, we are taking E itself. D plus E divided by 3. So your E or earnings is divided by 3 and that is added with the dividend. And this entire factor is multiplied with a factor called M. Okay, this is the formula. So D is dividend per share, and E is earnings per share, okay, and what is M? M is a multiplier. This is a very traditional form of finding the value, because it is very arbitrary, because this multiplier and all is not generally known. You will have to assume. Okay, so this is not that popular also, but such a model is there. So I repeat, market price is equal to M into D plus E by 3, where D is the dividend per share, E is the earnings per share, and M is the multiplier. Okay, and if you see the problem, let's see question number 12. The earnings per share of a company is 30 and dividend payout ratio is 60. Multiplier is 2. Compute the price per share. What do you have to do? The EPS is 30, E is 30. So D is 30%, sorry, 60% of 30. 60% of 30 means it will be dividend payout ratio 60. So it will comes to, what is the DPS? DPS is 30 into 60, and that will come to what? 18 rupees. Okay, so and M is given to be 2. So P0 is equal to 2 into 18 plus 30 by 3. That is equal to 30 by 3 is what? 10. And what is 18 plus 10? 28. So 2 into 28. So that is rupees 56 per share. Okay, it's a very simple model. You just take DPS, you just take EPS, D plus E by 3, multiplied with multiplying factor. That will give you the value per share. It's only an arbitrary model. It's not a very accurate or very scientific model. Okay. Now, coming to the next question, question number 13. The following information regarding the equity shares of M Limited is given below. Market price is 58.33. See, the market price is directly given. Okay. Dividend per share is 5. Multiplier is 7. According to Graham-Dodd approach to the dividend policy, compute the EPS. Okay. So, you are given what? You are given market price, that is P0. What is P0? 58.33. Okay. Now EPS is given to be, EPS is given, no, it is not available. You have to compute it. Now DPS is given to be rupees 5 and multiplier is given to be 7. So we know that P0 is equal to M into D plus E by 3. Okay. And what is D0? Oh, sorry, P0. It is 58.33 is equal to 7 into, what is D? D is 5. 5 plus E by 3. That is 5 plus E by 3 is equal to 58.33 divided by 7, and that is equal to, okay, what is 58.33 divided by 7 will be 8.33. Okay, so E by 3 is equal to 8.33 minus 5, that is 3.33, and E is equal to 3.33 into 3, that is 9.99 or close to 10. So the EPS is computed in reverse working model. So EPS, earnings per share, is equal to rupees 10 per share. So this is Graham and Dodd model. Okay, now you have a very small question or one small model, the last model I would say in the traditional model, which is known as Linder's model. Linters, Linder's model. Okay, now as per this Linder's model, there are two things which affects the share valuation. One is target payout ratio. Okay, and the second parameter is the spread at which current dividend adjusts to target. Okay, so the current dividend payout ratio may be different than the target payout ratio. So the current ratio have to reach to the target ratio. Okay, so how the current ratio adjusts to the target ratio, that is what is known as the spread. Okay, so what I will do is I will simply move to the formula. Okay, as per this model, the current year's dividend is dependent on the current year's earnings and last year dividend. Okay, so this model says that current year dividend is dependent on two things. One, last year dividend, and current year earnings. Okay, and as per this, current year dividend is D1. D1 is equal to, you take D0 plus, with that you have to add something. Okay, now EPS is the current year EPS into target payout ratio. So EPS into target payout ratio is actually nothing but your the target D1. From this you minus what? D0. So that is the growth in the dividend. So this is D1 minus D0. D1 minus D0 is nothing but the growth in dividend. And with this you multiply something called an adjustment factor, which is AF. Okay, adjustment factor. So D0 is the, D1 is the expected dividend for year 1. Okay, now D0 is dividend for last year or present dividend. Now EPS 1 is the EPS for year 1. Target payout ratio, we know what is the target payout ratio. Okay, then AF is the adjustment factor. This is an arbitrary value. Okay, adjustment factor or speed of adjustment. See, this is the factor which connects what we wrote first, the spread at which the current dividends adjust to the target. So there is a target payout ratio which you need to achieve in future. Okay, so the target payout ratio is maybe this target payout ratio may be something which you have to achieve after 5 years. Okay, so EPS into the target payout ratio might be the DPS which you expect after 5 years. But will you get it in the current year? No, you will not get it. So to adjust for the current year, you are multiplying with the AF, adjustment factor. Okay, now let's do one problem on this. Okay, it's a very simple problem. Okay, given the last year's dividend of rupees 9.80, speed of adjustment 45%, target payout ratio 60%, EPS for the current year is 20%, compute the current year dividend using Linden's model. It is direct application. See, from these models you won't get any new questions, it will be just application of the formula. So learn the formula, that is enough. Okay, so D1 is equal to D0 plus EPS into target payout ratio, okay, minus D0 into AF. So D1 is equal to, what is D0? D0 is 9.80 plus, what is EPS? EPS is 20, and what is the target ratio? Target ratio 60%, okay, minus D0 is 9.80 into, what is adjustment factor? It is 0.45. Okay, you need to reach to a target ratio of 60%, but that is the future target ratio. Have you achieved there in the current year? No, you have reached only up to 45%. Now balance 55% is yet to go. That is why you are multiplying with 45%. So this is equal to 9.80 plus 20 into 60 will be 12 minus 9.80 into 0.45. Okay, so 12 minus 9.80, that is 2.2 into 0.45, that is 0.99. So it is 9.80 plus 0.99. So that will come to how much? Rupees 10.79 per share. So this is the expected dividend for the next year, D1. Expected dividend for year 1 as per Linden's model is rupees 10.79 per share. I hope this is clear to everyone. Okay, so this is Linden's model, right?